Okay, well, it is 4 o'clock, so we can go ahead and get started. So good evening and welcome to our third session of Maximizing Farm Profits. Tonight we have Ryan Smith with us, and he is the commodity manager at Central Indiana Ethanol in Marion. And he's going to be speaking with us about commodity markets and also giving us some insight on how COVID-19 has affected the ethanol market. So again, if you've joined us, you've heard me say it before, but if you have questions and you want to type them in the chat box, that would be the most efficient. And then we'll also have time at the end where we can unmute and talk a little bit more openly that way too. So Ryan, if you want to go ahead and get started, you can have the floor.
Good afternoon. My name is Ryan Smith. I'm from CIE, Central Indiana Ethanol, and I'm a commodity manager here. And we have been greatly affected by Chinese trade wars as well as COVID, as have you, regardless of whether or not you're in the row crop agriculture or if you're in livestock agriculture. Stephanie, can you hear me okay? Is everything working?
Yes, you are good.
All right. So first off, a lot of the information I'm going to show you, I did not create. There's too many bits and pieces from this and that that we put together. So John Stewart and Associates, FC Stone, Advanced Trading Inc., and Commodity Ingredient Hedging are all, there's information from them that's in this presentation, supplied by them. So I got to give them credit for what they've got put together. So first things first is COVID or coronavirus. We got the stay-at-home order, basically in late March, early April. And my family specifically, I guess you'd call me a typical American. We are not farming, no row crop or livestock agriculture, from a farm family, but not currently farming. So we do what I guess middle-aged Americans do. My wife and I have children. They're involved in athletics and extracurricular activities. So we got the stay-at-home order here in Wabash County, in Grant County, and school's out. All sports are suspended, and that's that. My family, our gasoline consumption dropped 60% overnight. So that was very interesting. At the same time, gasoline demand nationwide, which if you look at your top left graph, that is your US weekly gasoline demand. It dropped 40%. So gasoline demand in the United States dropped 40%. And that's important to us in agriculture because corn production is 10% of the gasoline consumption in the United States. So national gas demand is down 40%. Over here on the right side, your days of supply of gasoline increased drastically. No one was prepared to shut down our manufacturing, whether it be corn milling and ethanol production or gasoline production, kerosene, jet fuel, diesel, whatever it is. Liquid energies were not prepared for this. If you look at the bottom left, U.S. gasoline stocks, you can see that the green area is average or normal, and the blue line is this year. So our gasoline stocks seasonally are excessively high, or were excessively high. They're still very, very high. So problem number one, COVID, national shutdown, gasoline demand drops. And how do I get to page 2? Uh-oh. Oh, there we go. All right, so ethanol is 10% of gasoline. So here we go with ethanol. This is 2020, essentially. So over here on the left, in the total stocks, the top left graph, week 1 would be like January. And as you can see, the stocks, the total stocks, are approximately week 12 skyrocket up to 28,000. And the theoretical maximum capacity is in that 28 to 29,000 barrels or billion barrels, something. Anyway, we were right at 98, 99% of our theoretical capacity on U.S. ethanol storage. So stocks shoot up, go to the right, total production. At the same time, the ethanol industry production declines. So demand drops 55%. If you look over here on total demand, bottom left graph, ethanol demand dropped 55%. Ethanol prices set 40-year lows at 80 cents a gallon. Ethanol plants shut down, and that's your top right, your total production. That's your national production of ethanol. There was no demand and storage was full, which is your stocks, top left. In Indiana specifically, 10 of the 14 ethanol plants that were operating in February of 2020 slowed down or stopped significantly. Just to kind of give you an idea of what that is in capacity-wise, we Indiana ethanol plants can produce 900 million gallons annually, so just under 1 billion. And in mid-April, we had 5 ethanol plants that were operating around a total annual production of 300 million gallons. So we had shut down the Indiana ethanol production basically 65 to 70% of what it was doing in February. Now, if you think about that locally, Bluffton, which is a very large ethanol manufacturing facility owned by Valero Oil, they shut down back in September due to poor margins. So they're not even included in this calculation. So that's just idled capacity that doesn't even count. But in February, we had 900 million gallons in the state of Indiana annualized producing. In April, we were down to 300. So that's a big deal. And it coincides with this total production. It wasn't just here in Indiana. It was all over the Corn Belt and all over the nation. Why did we shut down? Well, 2 reasons. One, there was no storage, so no one would buy my product. The second reason is margin, profit, or the price. So if we look here at the graph in front of us, we are looking at the April 2020 ethanol price. And basically all of last year, all of 2019, the price pretty much ran between $1.60 and $1.35 a gallon, which is pretty normal, pretty typical in the ethanol, average pricing over the last decade. The low was like 84 cents a gallon over here in April of 2020, and it finished the end of April. Ethanol prices in Chicago finished right around 90 cents a gallon. So from that killed basically a huge chunk of your corn demand. And during that same time period, we had, so here's the 1st of March on this graph. This is corn prices at CIE. And so the top graph is cash prices. The bottom graph is the cash basis. So corn prices at CIE on March 1st were above $4. The corn basis at CIE on March 1st for April delivery was approximately 20 plus 25 basis. by the end of March or the 1st of April, we were down around 325 a bushel, and the corn basis was down around -10. So basis had moved approximately 35 cents a bushel negative, and futures had moved drastically as well, about 50 cents a bushel. So the bottom of the corn prices, or the lowest point we got to, was right around 290 a bushel. And for the time of year, that's just exceptional, and it's unheard of, because we're starting to enter into the Northern Hemisphere risk season, our growing season. So this was a pretty amazing move, justified by COVID, basically, and the national shutdown. So let's put it in like profit perspectives for an ethanol plant. And if you look at this is a national ethanol margin. It's like a spot margin or a spot profit index for various regions. There's the Columbus, that's Columbus, Ohio. There's MN area, which is Minnesota, that's the blue line, and then there's Nebraska, the red line. So if we scroll down just a bit more, whoops, and we look at over here, we look at April, we placed absolute margin lows that will go back basically to around 2012. We were at zero margin, we were at negative margin, depending on who you are and where you're at. So there was no incentive for any of the industry to produce ethanol, let alone lose money. In that situation, and it's not the first time that this industry has faced it for various reasons, but in this situation, the way we kind of think about it is what loses less money, shut down and idle, or run at like a maximum efficiency or a minimum production type level. So generally speaking, it costs a lot less to shut down and idle the plant and even keep our employees and be doing maintenance and repairs than it does to run and lose money. This business produces a lot of gallons, so you can lose a lot of money real fast if you're a negative margin. Stephanie, I have a question, if you can
yes.
unmute. If anyone has a question, do they like unmute and stop me?
Yeah, that's what they can unmute, or they can type in the chat box, and that's what I've been watching, the chat box, to see if anything comes across too.
Okay. So we've gone through, we lost gasoline demand, we lost ethanol demand because of gasoline demand. We lost corn demand because of lack of ethanol demand. Here is the June ethanol price. So in late March, early April, we see these low prices that were being set basically in that 90 cents a gallon range. There was a carry in the market at that time, similar to the carry you get for stored grain normally, or at least you're shown it. And then, from late April, early May, as gasoline demand started to increase a little bit, so did the demand for ethanol. And now we're actually up in the $1.25 a gallon range. So we're not a large deviation from average or normal. So ethanol is profitable today. It's June 23rd, and we are profitable. And if we run back up and look at gasoline demand, over here, the top left, U.S. weekly gasoline demand, we are now back around, I think it's 88% of 88% of historical average. So, gasoline demand has rebounded quite nicely, especially considering how many states, including our own, still have quite a few industries and businesses that are restricted to a degree. All right. Now, domestic gasoline was certainly not immune. If you recall, at the beginning of COVID, we actually had crude oil. West Texas WTI crude oil went negative. Price went negative. I doubt we'll ever see that again in our lifetimes. I doubt it'll be allowed. But that guy, there's a few people that made quite a bunch of money that week, and a few that lost. But here's your crude oil estimated demand. It's everything from, it's plastic to gasoline to jet fuel to diesel, kerosene, whatever. Your crude oil estimated demand in your top left graph is rebounding quite a bit slower than gasoline, but that's normal. Your days of supply of crude oil is very high. And then your stocks are your U.S. entire nation's crude oil stocks are pretty high, and they're seasonally exceptionally high. All right, so at the same time, we had an ethanol fuel demand diminish quite a lot. We also had alcohol demand increase. So alcohol is made from corn. CIE is a alcohol manufacturer. In addition to fuel ethanol, we make clean alcohols for various uses. And those uses include disinfectants and hand sanitizers. Many of your hand sanitizers are 60 to 85% alcohol, and then additional ingredients to make it undrinkable as well as easier to use. So your alcohol manufacturers that are making alcohol for various purposes, their demand for products was very high, but there's not enough. It's just not a big enough market that the ethanol industry could really play that game, even with the alcohol demand we've had during this COVID virus. So a few ethanol plants are probably going to convert and add cleaner alcohols or industrial use alcohols into their portfolio, but there's not a really big market there. Now, the alcohol demand for hand sanitizer was so great that distilleries that manufacture beverage alcohol were actually deviating or differentiating by reducing their beverage production for various products and increasing or turning a new production line, which is just straight hand sanitizer grade alcohol. Some of the distilleries that we work with actually did that, including one in Indiana called Cardinal Distilling, which is in Bloomington, Indiana. So what we did not stop production because we do have a diversified line, and we essentially just maximized our efficiency and maximized our alcohol and industrial alcohol production and minimized the amount of fuel ethanol that we produced. Our fear during the COVID time or during the shutdown was that we would have to stop production because of lack of homes or lack of places to put the fuel ethanol that we have to make. We have to make fuel ethanol to make alcohols. So let's get back into corn. All right. So corn prices dropped 35% in late April. I don't remember exactly what the day is, but the federal government did offer agriculture a COVID bailout or, rescue package that many of you are eligible for, I'm assuming. And so that it is a fairly sizable sum of money for those that are eligible, and and you add that on top of today's corn price, and it's not going to send anyone to bankruptcy court. Most everyone that is eligible for the COVID funding is going to live to fight another year or live to farm another year. So looking at right now, gasoline demand has increased, ethanol demand has increased. Corn basis has jumped quite a lot. Corn basis is up from, it was -10. We are at +12 today, so it's up 22 cents on our posted bid. And ethanol plants are turning a profit. There is a reasonable amount of demand for our product. And if you look at corn basis specifically, it is back near the seasonal average. Now, putting it into corn perspective, Indiana ethanol produces 900 million gallons annually. We talked about that. That's 76 million gallons monthly, which is 27 million bushels per month of corn consumption in the state of Indiana. We lost about 2 months production here in Indiana, which would be 54 million bushels of total corn demand loss for Indiana alone. Just to kind of relate that to local, CIE in a normal average year will use around 25 million bushels of corn per year. The local poets, I think they're around 27 or 28 million bushels per year. So if you spread that out over the nation, we lost somewhere between 300 and 600 million bushels of corn demand. The 1920 corn carryout, and if you look at your screen, we've got on the left side U.S. corn supply and demand. The June 1920, it's the old crop corn. We're looking at ethanol use. So in May, the USDA said we were going to use 4950 or 4.95 billion bushels of corn for ethanol in our old crop, and then June they dropped it 50 million bushels to 4.9 billion bushel. So the USDA has not made a meaningful adjustment to account for the corn demand losses due to COVID and gasoline consumption. So if you look at your carryout, we were 2098. They've got us at 2103 this month, and many in our industry would expect that to rise. So the corn carryout for old crop could easily rise to like 2400 and or 2.4 billion bushels. Now the one thing that is really hard to calculate is ethanol plants manufacture ethanol and DDG feed, which is a protein byproduct used in livestock feeds. The loss of the DDGs does not have a direct one-to-one correlation to the additional consumption of corn like in a pig diet, but there is a correlation. So what we don't know is when we lost all that ethanol production, which dropped the DDG supplies and production, how much of that DDG feed demand was replaced with corn demand. And so that will, give them a lot of negotiation room when they're trying to figure out what the feed and the ethanol demand is going to finish at, looking at the USDA numbers. Sorry, I got to check my notes. Locally, all the feed mills that we sell DDG feed to, all of them, except for one, removed DDG from their pig diets in March or early April. Many of them, but not all of them, so roughly 70% of them now have DDG feed back in their pig diets. And why did they do that? Two reasons. Well, one specifically, the price of DDG in the month of March and April actually spiked or rose because the supplies were decreasing so quickly. And the price of DDG peaked at $200 per ton, while corn bottomed at $105 per ton. Normally, DDG and corn are basically the same price per ton. We're pretty happy when we're selling 100% the price of corn. So that's it was a big deal if you had DDGs sold and you're in my business. So looking at new crop, U.S. corn supply and demand, the top left box, we're looking at the fourth column, June 2021. So this would be the new crop that we're getting ready to, or that we're growing right now. The government thinks we planted 97 million acres. They think we're going to harvest 89. That's a normal percentage. They've got a yield at 178, which is optimistic, but not impossible. Normally, if you're not familiar with the S&Ds, normally they start out with a pretty high yield. The carry-in is likely to increase for the new crop, but if we get down to the nuts and bolts of it, the carry-out and the stocks-to-use ratio is really important. The carry-out right now is projected to be 3.3 billion bushels. We haven't seen that in a long time. That's a big deal. That's bearish. That's like whole year bearish. That's like $2.60 a bushel corn bearish. It's a big concern if you're a corn producer. The carry out to use, CO use, which is also known as the stocks to use. This 0.225 is 22.5%. Normally I consider, and many consider, 11% stocks to use, that pivot point between bearish and bullish. So a 22% stocks to use is, it's a real downer. It's depressing. It's a major concern. Looking at soybeans, old crop, carryouts 585 on the old crop, the one that we're selling now or shipping now, and then the projected new crop carryout drops to 395. So it's a stocks to use that's below 11%. That's not necessarily, beans are a little different. That's not an exact rule as far as the 11%. It's actually a lower number, but beans are not super bearish. They're just neutral. So the gorilla in the trading floor is the funds. Everybody talks about the fund position. 2 years in a row, the funds are short going into the planting season on corn. And the red line is last year. Last year we set new lows like in early May, and of course we didn't plant anything till June. So you can see where the funds quickly went from early May lows to basically to July, or the end of June went to not all-time highs by any means, but above average long position for the funds. So this year it's now June 23rd. And the fund short position is setting its low, or just has set its lows for the year. So is anything going to spook them? The fund position itself, if you look at size of volume, it can easily move the market 10 to 15%. And corn is 330-ish today, July futures. So 10% of that's 33 cents, so that's 360. You know, you add a positive basis and you're looking at 370, 375 cash summer corn. That's probably 370, 375 fall corn as well. So if something spooks the funds, that's a big deal, and it could get you back into the range of prices prior to harvest that are fair and reasonable. And it's looking at what the potential carryout is at 3 billion bushels or more, if we have a good growing season. 360, 370, 380 corn is a good price. Here's carryout ratios on corn, just to kind of put it in visual perspective. The top left, carryout to use, that's your stocks to use. The 2020 bar at 3+ billion bushels is just amazing. We haven't seen it in over 20 years, as you can see. You know, you're looking at 2012, $8 corn. That was down around 7 to 8% stocks to use. And so this is bad. This is very bad. Where did all this corn come from? Planted acres, harvest acres, and anticipated yield. Obviously, we're not going to yield that much, but we can still have 2.6, 2.8, 2.9, maybe a 3 billion bushel crop. Corn yields is the little orange line here. So USDA has a trend style yield projected, and they'll adjust that. You know, looking at 2019, yields came down quite a bit from trend, but it's, you get a lot of acres. Soybeans, top left is stocks to use or carryout and carryout. And it's kind of neutral. It's middle of the road, midpoint. It's average. It's not bullish, not bearish. Could go either way if you're looking at gross fundamentals of soybeans. So real quick, we'll run through a little bit of grain marketing ideas. Every year for the last 12, I think it's 13 years now, we've had an opportunity to sell $4 corn, old corn and new corn, in May or June or July. This year, it doesn't look like that's going to happen. This will be the first year in like 13 that we haven't had that opportunity. It's been so consistent that many of our producers that we do business with expect it and plan for it, and we've got marketing plans designed around that summer selling season. So during that summer selling season, the reason the market runs higher is because there's a production fear. You know, the crop is struggling somewhere and somehow. So we need that. You need that so you can get your marketing taken care of, or get at least a reasonable start on your marketing. And you know, when you look at it, often like last year, in June, corn was $4.50 to $5. You hadn't planted anything, and it's very difficult to sell in that situation. 2012 was the same way. We were in a drought, very difficult to sell. But we have to, you know, methodically, if we want to maximize our revenue per bushel, we have to methodically plan and manage and sell. This past year, or 2019-20, we had $4 all winter. Many of you sold a lot of grain, and that's good because that's going to help your average. But we were rightfully expecting, you know, $4.50-ish this May, June, July, because of where winter was at $4. And because of the known production issues that we had in the eastern United States. Well, COVID ruined that plan. So what do we do now? Just as a caveat or a side note, I raised corn in 2012. I forward contracted $4 corn, and I ended up having a crop or a production that was about 35% of average, and I lost a pile of money. So clearly I'm an expert. I sold forward contracted corn in 2012 when it went to $8, and didn't get to enjoy that. Looking at historical since 2007, which is when the ethanol business really started to consume some corn. This graph is how many weeks has corn spent at various price ranges. So since 2007, we've had, and this is corn futures, we've had 1 week where corn futures was below $3. We've had 354 weeks where corn futures was between 3 and 4, 102 weeks where it's between 4 and 5, And then of course you got 6, 7, 8, and so forth. It's kind of amazing to sit there and think about it. In the last 13 years, you've had 54 weeks where corn was between $7 and $8. That's an entire year. Since 2014, below $3, you've had 0 weeks. 3 to 4, you've had 238 weeks. 4 to 5, you've had 35 weeks, and 5 to 6, you've had 3. Now, this is not updated for the last 7, 8 months. So this data is a little bit old, but it is still relevant when you're thinking about, all right, when I market my grain, specifically my corn, what is a good price? Well, since 2014, $4 has been a pretty good price. Last summer, in particular, minimum price contracts. I love minimum price contracts because it allows you to market your grain at a reasonable price. And if corn runs up higher, it allows you to sell additional money. So all it is essentially is you're buying a put on the Board of Trade. If you do it through your broker, great. If you do it through a grain buyer like myself, we can throw it into the price. So let's say, for example, cash fall corn is $4.20 delivered. Generally speaking, this time of year, the cost of the option is around 20 cents. So if you see fall corn is $4.20, generally speaking, you could set a minimum price contract at $4 net. You're getting $4, end of story. And if the market rallied to 5 or 6 for some late season production problem like 2012 had, you would get to, capture additional income. You still have to raise the bushels, but you could capture additional revenue per bushel. So minimum price is a big deal. It's a great marketing program. Obviously, you can't do it right now. It's just not available. There's nothing you can set. I mean, you could set $3, but that's way below crop insurance values. And then if you look at historically, how much time do you need when you're looking at a minimum price styled contract? Usually, if there is a major production problem, it's going to happen in the summer, and futures market will rally during the growing season. So if we look back at the 2012 crop, here's early June. Corn was really high. Anyway, here corn was approximately $5 according to this graph, and over June, July, August, so roughly about 90 days, we increased prices $3 a bushel, and that's all you need on a minimum price contract. Growing in popularity is also accumulators and other creative marketing structures. Sometimes I call these schemes because there's a little, it's kind of, there's risk in it. So accumulators and other marketing structures essentially pay you a premium for you accepting some level of risk. As an example, like today, we've got people that have accumulators at $4.50, $4.20, $4, and we generally promote that they keep it a fairly small percentage of their total production, because accumulators can get out of hand and you can get in trouble. Because there's generally an obligation or an additional obligation to sell more grain if something happens. We, CIE, we sell the accumulators when we believe that the price is high and there's a good value for you. And that would be, when I say we sell, that is us actively outbound calling saying, hey farmer, have you thought about this? Or would you like to learn more about this? Or do you want to try a couple loads of this to see how it can enhance your marketing? Now we can build them. Like if you call in and say, I want to know what all the accumulators are doing today, we can tell you, we can build them for you at any moment that the market's trading. And just to kind of give you an idea on marketing, we do have customers that will average $4 for corn on the old crop. Nobody on the new crop is even close to that at the moment because they don't have very much sold. But we do have customers that will average over $4 for the old crop. And I'm not just talking about the guy that sold his grain all at harvest. That guy got lucky last year, or smart, whatever you want to call it. But there are some methodical marketing guys that sell a crop over 12 to 24 months that will average better than 4. So looking at this year, what are your neighbors doing? We've got a couple of percent. We got 3 to 4% of producers who have up to 20% of their new crop corn sold at $4 a bushel, and that's about it. As far as what they're doing with brokers and other marketing or grain buyers, I have no idea. But here, probably the most sold of anybody I know is around 20% on the new crop. Let's see what else I got. So corn's bearish, and what can change that? Corn's bearish until something significant happens. There's really 2 major things right now that could happen, or over the next 6 months, that could be bullish. One is a major crop production loss, significant drought, or something like that. Iowa's getting rain, so it's not going to come from there. The next one is major export demand, and really the only player in the world who can buy enough corn to have a significant impact on prices is China. And they've got a trade deal with our federal government, and hopefully they're going to honor it, and that could include a sizable amount of corn and other corn products. So we'll see how that goes. China's really good at buying cheap stuff, so you would think if they were going to do a major export program or import program from the U.S., that they've certainly already bought the futures or are buying them now at lower prices. The domestic corn demand for feed and ethanol is pretty steady. It grows annually, but it's got a pretty steady and stable growth rate. It is. There's nothing new that's going to come from the United States at this time or in the next 2 to 3 years. So Stephanie, that is all I've got in my notes. CIE, so we make clean alcohol, about 45 million gallons a year. We make ethanol, about 25 million gallons. That's for fuel. And then we use around 25 million bushels of corn per year. And we make 200,000 tons of DDG per year. Our DDG is about 50% Indiana livestock product or feed, and 20-25% goes to the Southeast feed markets, and then 25 to 30% goes export to Asia through Chicago, and it gets loaded into containers that are being returned to Asia. They send Hot Wheels and video games over here, and we send DDG back. We are now 16 years old, it appears, and we've been in production for 13 years. So that is what I know about COVID and this year's grain marketing program. Any questions?
Well, if no one has any questions, we can go ahead and wrap up. Ryan, thank you very much for that presentation and giving us some insight on how the markets have been working and moving the last few months with all the COVID stuff happening, as well as kind of looking forward into what they could do coming here in the next few months. So with that, if you do ever have questions about anything, you can always reach out to Ryan. And I can get you his contact info, or you can call CIE direct and they can get you to him. So with that, I want to thank you all for joining tonight. Again, I'm going to be sending out a survey, so I really appreciate, and I do appreciate the people who have responded the past couple as well. So we will reconvene on Thursday, and we're going to be hearing from Drew McCulley with Global Ag Risk Solutions. And that will be wrapping up our 4th session and concluding this entire series. So I will see you all Thursday, and I hope you have a great evening.
Thank you. Good night.